Welcome. This is Accounting with Bennett Tchaikovsky. Our topic today is going to be the statement of cash flows. This is going to be the introduction video. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky. If you have any questions, you can reach me either at 1812cpa@gmail or bennett1812@gmail. I appreciate your questions and feedback. And perhaps I can put it into, if you have a great one, I can film it or I can record it, give you a tribute, and then post it up as a YouTube video. So right over here, in terms of cash flows, and let's take a step back. When we're going through and preparing financial statements, the statement of cash flows is a very important financial statement, and I don't want to diminish it. However, it's not what we call a core financial statement, meaning that I can't live without it from a financial statement perspective. And the reason is that my income statement is showing me what I earned during the period or what I lost. That net income goes to the statement of retained earnings or the statement of owner's equity. And then ultimately that's going to be traveling to the balance sheet. Essentially in the form of retained earnings. And so when we look at the statement of cash flows, what it's really showing us is how did we get from our beginning cash balance to our ending cash balance. And the reason why, and let's just kind of take a look right here, and what I've tried to do is pull up, hold on, excuse me. What I've tried to do here is if I look at, this is the statement of cash flows for Amazon. And this is for the quarter ended or the 3 months ended March 31st, 1999. Yes, Amazon was around back then. And if we look at Amazon and we see the cash balance as of December 31st, 1998 was about 25 million. And its ending cash balance as of March 31st, 1999 was about, $5 million, which just kind of seems so small today. If I remember this 5248 and this 25,561, and I go down here to my statement of cash flows, what I'm really doing with my cash flows is I'm taking my net income or my net loss, and I'm essentially showing what happened to cash by going through these different areas. And this is what we're going to be preparing. So cash decreased by about $20 million. And so here's my cash at the beginning. Here's my cash at the ending. And if you're wondering how I look this up, I have a presentation, how to look up company financial statements on sec.gov. So please feel free to go look at that video. And I come down over here to the cash at the end of the period. And, this is really what the statement of cash flows is showing us. How did we get from our beginning cash or December 31st, 98 to my ending cash balance? And where did that all come from? And so in terms of seeing how cash changed, and the reason why it is important is that where is my money coming from? Is the cash that I'm generating coming from my normal operations? Did I raise a lot of money? Did I invest money? What's happening? So this statement of cash flows is going to be giving us some very, very good information. However, it's not a core financial statement. When it comes to teaching accounting, I generally do not teach cash flows, nor do I mention it until the very end of the semester. The reason why is that if you teach it properly, you can essentially make it, the final is essentially cumulative, because guess what? I can do an asset sale. I can do a bond issuance. I can do all these other types of things. I can show the depreciation or the amortization, and you have to know how to do all those things in order to prepare a statement of cash flows effectively. The other reason why cash flows are extremely important is that the financial statements have become littered with so many different non-cash items that if I'm an investor looking at a company, I almost need to back out a bunch of stuff. And here are some examples like the loss from derivative liabilities, goodwill impairment, stock compensation expense, hello Twitter. And what I need to do is when I'm evaluating a company, and this is from an investor perspective, I need to do a lot of add backs because stock compensation expense doesn't really cost the company in most cases anything. Rather, I'm giving options to my employees. And I'm going to pull up Twitter just really quickly. So I'm going to pause my presentation right now and we'll be right back in 2 seconds. And we're back. And so with Twitter, Twitter had a net loss for the 9 months ended September 30th, 2018. Excuse me, they had a profit, excuse me, Twitter. They had a profit of $950,293. But if you look at, say, here for the 9 months ended September 30th, 2017, Twitter was operating for financial statement purposes as a net loss, at a net loss of almost $200 million. But this is from their operating section of their statement of cash flows. And what we see here are these various different non-cash charges. One of them being stock compensation expense, which again, it's required by financial statements, but it's not really, in my opinion, a true indicator of profitability. And so here we're going through and adding this back. And this is why the statement of cash flows is so important for investors, because they need to see what types of charges are being, what type of charges are these accountants coming up with, and what do we need to go through and add back. Another one, when we're looking at Twitter for the 9 months ended September 30th, 2015 and September 30th, 2014, well, it was at a loss of $430 million, but if I added back the stock compensation alone, Twitter becomes profitable. Same thing here. I was at a loss of $452 million. I add back the stock compensation expense, Twitter becomes profitable. So when a stock analyst or an investor is really trying to see how a company is performing, they need to go through and add back a lot of things that are put in there because of financial accounting rules. And that's probably the most important part of this statement of cash flows is how are we helping the investor? And remember, when we are going through and preparing financial statements, who are we preparing them for? We are preparing our financial statements for the investors or those that want to be loaning money to the company, interested parties. And this is what we always have to remember is that, again, we're making these financial statements for the investors. These are for who they are. They're not for some, and again, this is not an offense to the FASB, but it's not for some kind of exercise, because I truly believe what has happened is we've gone so far over the rainbow, or I should say, I'm not sure if it's over the rainbow, someone already has that copyright, but we've gone so crazy with some of these rules, and it's just going to get worse with leases. So again, this is why this statement has become so important, because we really need to figure out what do we need to go through and back out to see how a company is truly doing. So when we're also with cash flows, so again, we've just kind of talked about the importance of cash flows to our investors. But now, would we ever be showing this internally? And the answer to that is no. I don't want to show this internally, and why? Why do I not want to show my financial statements internally? Well, I can do so, and it's a way of learning from the past, but really what we want to be focusing on is the future, okay? And when I'm looking at cash flows, it's not really helping me with the future. When I'm doing a future cash flow projection, and one of the most important things that you can be doing when you're going through and helping out a company is, what is my cash flow going to look like for the next 12 months? The statement of cash flows doesn't do that. Rather, our cash flows are focused on the past. But if you want to learn about how do we go through and, how do we go through and record, or how do we prepare a 12-month cash flow, one of the things I've done, or thank you to Roger's CPA review, I created, essentially it's an article that's essentially, it talks about right over here, teaching budgeting with cash flows. And if you go down here to the step 3, which is preparing a 12-month cash flow, if I click on this link, it's going to take you to a Google Sheet, which is going to show you a full 12-month cash budget. Now, I'm not saying that this is perfect. It was created by some of my former students, but I'm leaving this up here. And just, again, this is really what I should be showing my company, because if I go broke, and if I can't pay things, then I have a huge problem. So again, this is why this is much more appropriate in terms of a cash flow. But when we're going back here, right, we're not dealing with that. We're showing on our balance sheet, we have an opening and an ending cash balance. And what we're trying to show our readers is, how did we get from our beginning to our ending cash? So the first thing here is that there are 3 sections on the statement of cash flows. And this is a more recent statement of Amazon. And so, wow, this is nice and huge lettering. Thanks, Tchaikovsky. I'm making it smaller. I've just lost it. And here we go. There we go. And hopefully I'll be able to navigate this. There we go. So when we have a statement of cash flows, what I'm doing is I'm showing investors, where did my cash come from? Here's my beginning cash. I'm looking here at cash flows from my operating activities. Then I have my cash flows from my investing activities. And then I have cash flows from my financing activities. And this is clearly a larger publicly traded company, but it works for our purposes, because this is kind of showing us, well, where is everything coming from? And so where is our money coming from? Did I do it through financing, investing, or operating? I've got my total change in cash, and then right over here, net increase in cash and cash equivalents, and then I've got my ending cash. But let's go back over here and talk about this more. So there are 3 sections in a statement of cash flows. There's financing, investing, and operating. For financing, this is really telling us is, how are we financing or raising funds or operating our business? And so here we've got a sale of company stock. If I'm repurchasing my own company stock, this is not the stock of another company. This is my own company. Dividend payments, issuance of a company bond, repurchase of a company bond, and then right over here, leasing transactions. And as we saw just there in Amazon, that they were going through and including some leasing transactions. And again, should we be including leasing transactions? Well, it's the first time I've ever seen it, but given where leasing is going, it's probably not a bad thing to be including in financing, because if we're entering into a lease, that's part of the way we're going through and financing our business operations. Investing. How is a company utilizing its resources? If I'm purchasing property, plant, and equipment, if I have cash proceeds from the sale of property, plant, and equipment, I'm having over here a business acquisition. And then lastly, I've got over here, I've got my marketable securities. So, and again, if we look here at Amazon, and this is Amazon for the 3 months ended September 30th, 2018. So this is their more recent financial statements. I can kind of see here, what are their investing activities? sales and maturities of marketable securities, acquisitions, proceeds from property and equipment, and then purchases of marketable securities. Every company will have different categories, but in general, when we're looking, or I should say not categories, but rather descriptions. But in general, over here, as far as investing activity goes, we can really kind of break it down for our purposes of purchasing property, plant, and equipment. When we sell equipment, I've got a business acquisition, I'm buying a business, or if I'm purchasing or selling marketable securities. And again, what are marketable securities? Those are investments that we are using our idle cash in. Now for operating, it's pretty much everything else. And these are going to be non-cash expenses and revenues such as depreciation expense, gains and losses from asset disposals, liability, retirement, stock compensation expense. Also, we're going to be having here the change in operating balance sheet asset accounts, receivables, inventory, and prepaid expenses. And then lastly, changes in operating balance sheet liabilities, payables, accrued liabilities, and so on. We're also going to be starting out with our net income or our net loss. And right over here, when it comes to the way we prepare our statement of cash flows, I am going to be using the indirect method. And this is opposed to the direct method. And my challenge to you is that if you find a publicly traded company prior to, where are we right now? November 12th, 2018. If you find a publicly traded company that's listed on the New York Stock Exchange or the NASDAQ that in the last 10 years used the direct method, please send me an email and I'm going to record a 1-minute video just of me saying how awesome you are. And I can either sing songs from like a Lego movie or whatever, as long as I don't get in trouble. And this is really something important because I was at a conference about 2 years ago and somebody was saying, oh, the direct method's coming back. And it's like, really? Okay, here we go again. And for whatever reason, some academics love the direct method. I haven't seen it. You know, I'll love it if I see it. So help me out, get me some love, and find me a statement, find me a publicly traded company that uses the direct method. Okay. And again, my entire life, I've only prepared the indirect method. I think I may have practiced the direct method when I was taking the CPA exam, but that's really the only time I've ever seen it. It's kind of like some of the year's digits. We just don't know. It's out there in academia land, but it doesn't really exist. So when we're preparing a statement of cash flows, what we're going to be doing is we're going to first, there's a couple different steps. And so the first step we're going to do is we're going to create a skeleton. And the skeleton is essentially going to be the same for every single type of statement. My recommendation to you as you are going through and preparing a statement of cash flows is that you're going through and writing everything out. I cannot tell you the importance of going through and writing everything out as things come up and doing accounting. Practice makes perfect. You have to practice. And so right here, I'm going to have my company name, statement of cash flows, and then for the year ending. I'm going to start with my cash and cash equivalents at the beginning of the period. And this is something kind of new because when I've been, again, I'm learning too. And when you're looking at the new statement of cash flows, they start with cash at the beginning of the period. They go into operating activities, financing, and then you're going to have here the change in cash gives you cash and cash equivalents at the end of the period. So we're going to start here with our cash and cash equivalents at the beginning of the period. We're going to have our operating activities. We're going to take our net income or our net loss. We're going to look at adjustments to reconcile net income, net loss to get to our net cash from operating activities. So this right here, our net cash, and we'll talk about this a little bit later. When I'm going through and preparing the statement, if the number is positive, it is going to be provided by. If the amount from operating activities is negative, it's going to be used in. What I then do is I'm going to come up with my investing activities, and we'll look at examples a little bit later. And then I'm going to have my net cash either provided by or used in investing activities, financing activities. And so my net increase in my cash is the sum of the operating, investing, and financing. And I'm going to essentially then take that increase in cash and I'm going to add it to my beginning cash balance, and that will give me my ending cash balance. Below the ending cash balance, we're going to be having an area here for non-cash transactions, and we'll go over that in future cash flow videos. But again, this is meant to be an introduction to the statement of cash flows. It is a very, very important financial statement, mainly because it's helping our investors determine what type of non-cash items have we thrown in to our financial statements. And for companies like Twitter, which look like they're unprofitable, they are actually profitable because when you add back certain non-cash items, they're clearly ahead of the game. So thank you for watching this first introductory video. Please like and subscribe, and I'll see you on the next one.